Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are looking at the Vanguard High Dividend ETF, that's VYM. And the reason we're looking at VYM is not because it's Sharia compliant. I'll explain why it's not Sharia compliant in a second, but it's because I was talking to a friend of mine and he said, I have £14,000 and I want to put it into the stock market. I don't like picking individual stocks. I don't think I have the time. I want an ETF that will basically, I can just dollar cost average into every single month, okay, and forget about it and possibly, look at it maybe in about 10, 15, 20 years from now. And it just kind of got me thinking. I'm just thinking, yes, the couple of ETFs that we found so far, the iShare ones, okay, and he basically, one of the things that he doesn't like about this is because the high expense ratios. So it's quite difficult right now to find basically an ETF that doesn't have expense ratio that's too expensive, because if you compare it to the VYM, I think VYM has 0.06 or something like that, and these guys are looking at 0.60 or almost, some of them are almost like 1%. So they are quite expensive, and remember, they're going to eat into your earnings in the long run and your returns basically. So that's one of the reasons I started looking at different ETFs, and then I came across VYM, and VYM is one of the best performing ETFs right now, okay, against the stock market, against the VOO, which is the S&P 500, is actually doing better than that. It's only down 1.83% and 6%. in comparison to 15% of the overall S&P 500, and that's basically year to date. So just since January up to now, is actually outperformed, okay, the S&P 500. Now, unfortunately, we can't invest in the Vanguard High Dividend ETF because it has 45% of these companies in there are Sharia compliant. 47%, according to Zoya, 47% are not compliant, and then there's a couple of that question mark whatever. So the companies that are not compliant include a lot of the banks, so like the JP Morgans, the Bank of Americas, and so on. And then you've got Philip Morris and all of these companies that are not Sharia compliant, but there are companies in there. So what I was just saying to my friend was, just why didn't you look at some of the best performing ETFs, okay, pick the first 5 or companies in there, and then create your own ETF based on that. Because what you're really doing is, if you're investing in this kind of ETF, you're betting on the companies, the top 10 normally is like 25 to 50%, right? So I just said, why don't you pick those companies? Those companies that in the top 10 will be around for a very long time. So maybe then construct your own ETF. That's in fact what I'm doing. So when I first started, I did that exact same thing. I looked at the best performing ETFs, okay, that were dividend companies and so on, and I just picked those companies that were in the top. It wasn't actually best performing ETF, it was by sector. So I was looking at the industrials and picking the first 5 or whatever, and see if they're Sharia compliant. Then start looking into their more fundamentals and see if I can add to that more portfolio. So that's basically what I've done. It seems in the last couple of days, okay, going back to just generally overall the markets, last couple of days, it seems everything is perfect, okay? But the fear and greed index is still high, okay? Extremely fear at the moment. So despite the fact that we get a little bit of relief, okay, we might not be still out of the woods. I wish we are. I hope we are, and I hope basically we hope to see more greens in the next few weeks, because it's been red for a very long time. Okay, and the portfolio is doing all right generally. Okay, I've got a couple of videos coming up because I haven't been well enough to put a lot of videos out. Inshallah, I've now got a lot of plans. In fact, I made a huge mistake during that basically last few weeks, and that I'm going to share with you. I've lost quite a bit of money, so I will share that with you as well. Like I've always said to you, whether good days or bad days, okay, whether I'm making money or losing money, I will share that with you, inshallah. And that was my plan, and that is the reason I started this YouTube thing. So if you like that kind of transparency, if you like what we're doing here, just please, all I ask is, I've got no courses to sell, nothing else to sell to you. just give it a like the video, subscribe to the channel. Okay, let me know if you have any questions. And some of you are new to the channel, welcome. Okay, welcome to the channel, and if you ever have any questions, please let me know. Right, so let's look at so what I did was I just looked at the Vanguard the VYM, and what I'm doing now is I'm looking at the top 10 companies, top 20 companies, and pick the halal companies in there, or Sharia compliant companies. So at least someone like that brother who is struggling to find in basically a nice ETF can possibly construct and use this opportunity to maybe this opportunity. What I mean by that is the fact that we've a lot of these companies are down right now. Although this ETF is doing really well, some of the companies in there might not be doing so well. So let's have a look at the companies in there, and then we'll take from there, inshallah. Right, so what we're looking at is we're looking at the ticker, we're looking at the company, we're looking at the sector, we're looking at the yield. Okay, so that's the dividend yield, 5-year growth rates of that dividend. So payout ratio. Okay, so how much are they increasing in the last 5 years? Basically payout ratio, how much of their net income are they spending on basically paying us the dividends? Because some companies unfortunately spend about almost 100%, sometimes more than that. Because they just want to keep you happy, and those companies, you need to run away from those companies. And a lot of these companies include the oil companies, the real estates and so on, although real estate is slightly different because they have to pay a lot of that as a dividend. But you have to be careful when it comes to these things. Okay, we're looking at the safety according to Simply Safe Dividend. Okay, see, anything above 61%, 60 whatever, that's fine. Anything below that, that's a little bit scary. Okay, they can cut it, and the reason we're looking is we don't want the dividend to be cut. Okay, so you buy stock and you want to hold it for 10 years. You wanted that dividends to grow every single year, so you can compound that that dividend, as well as making sure that dividend doesn't get cut. Years in dividend increased. Okay, how many years they increased? Okay, that's the percentage of the last 5 years. That's how many years have they been increasing that dividend. Okay, we're looking for companies hopefully that are dividend aristocrats or dividend kings. Dividend aristocrats have increased their dividends, okay, 25 years or more. Different dividend kings have increased their dividends for about 50 years or more. Profit margins, we're normally looking at anything above 10, 15. Okay, that's absolutely what we're looking for. The profit margin tells us basically the company is profitable and actually they head in the right directions. After they paid all the expenses and all that, they still have money left over that then goes into the net income, then that goes into you getting paid dividends and so on. We're looking at free cash flow here, really important. Okay, if a company has a free cash flow, what they can do is they can buy back their own shares, they can pay you dividend, they can pay down debt if they have debt, they can acquire other companies. Okay, they can do a lot of things. They can use that for research and development. Companies that do not have free cash flow, I'm trying to stay away from them. Okay, and so they just try to basically make sure the companies that you're investing in have some sort of a free cash flow so they can do all the things that I've just said. Okay, we're looking at total returns for in the last 10 years. That including price appreciation and dividends as well. This comes from Morningstar, so that's one of the reliable companies that I use. Growth estimates and in the next 5 years, so how, what the analysts expect from this company in the next 5 years. Okay, are they going to grow their earnings? Are they not going to grow their earnings? And companies that are not growing away, basically growing these things, you're going to have to be really careful. Then you've got Morningstar valuations. So this will tell us whether it's overvalued, undervalued, and then fair valued. We'll see the fair value price. Okay, so Morningstar will say it's 5% overvalued, and it will tell you the price where they think the stock will be fairly valued. Okay, and that is it. So let's get started and look at these 10 companies. Again, I'm going to give you the overview, and then if you're interested in individual stocks in this, then you have to do your own research, obviously. Okay. Right, so the first company we're looking at is this company here. Let's go and click this and hide. Right, so the first thing we're looking at is J&J. J&J is in the healthcare sector, currently has 2.58% dividend yield, 6% 5-year growth rate, payout ratio only 43. Okay, only 43%, which is quite nice. It has a dividend safety of 99%, and that means that dividend is safe. That's the highest, basically, simply safe dividend gives. Okay, no company has 100%, obviously. 5-year growth rate, 5 years, basically they've increased their dividend, okay, 59 years. So they are dividend kings. Profit margin of almost 21%. They have a free cash flow of almost $20 billion. Total return in the last 10 years is about 13%. The analysts are expecting the company to grow their earnings, okay, about 5% in the next 5 years. Company like J&J is not easy to grow, okay, organically. So you're expecting about 3 to 7%, 8-9% if you're lucky, this type of companies. And this company is right now overvalued, okay, basically trading premium about 8%, and the price should be $167 per share, okay. So that is Johnson & Johnson, and Johnson & Johnson is about 3.34% in the VYM. So if you bought a VYM, you will be buying 3.34% of that entire thing will be Johnson & Johnson. Okay, so you could have done the same thing and have a portfolio, okay, that has a 3.34% or 3.4%, okay, of J&J in your portfolio when you're constructing it. If you imagine your portfolio was 10 companies, you could do it that way, or you can split it more, whatever, however you want, okay. So that's the first company. The next one, again, is a very stable company in the consumer staples. That's Procter & Gamble. They have 2.52% dividend yield, 5-year growth rate of 4%, payout 61%, dividend safety 99%. 5 years, basically they have increased this dividend 65 years. So another dividend king. So you don't basically none of us are expecting these dividends to be cut anytime soon. Profit margin 18.33. Free cash flow almost to $14 billion. They could do so much with that money. Okay, and companies like this, because they don't grow organically a lot, they actually buy other companies. They acquire other companies out there, smaller companies, okay, that they think will add value to their business. This company has a total return in the last 10 years, okay, of 10.55%. 5-year growth rate about 6%, so very similar. Okay, you're looking about 4 to 7, 8% for these type of companies. But right now is really overvalued, 17% premium. Okay, the price should be, according to Morningstar, should be 124. Right now, I think it's about 150 something, 160 something. I can't remember exactly, but that's basically what it is right now. So the next company that we're looking at is Exxon. So this is energy sector. And that is, Exxon is about, I think, 2.54% of that entire ETF, okay? And it currently has 3.88 dividend yield, 3% 5-year growth rate, payout ratio of 51, okay, and safety of 55. And that is where, for me, the problem starts, okay? Because you kind of buy in these companies for the dividend yield, and then you realize it's not really that safe, is it? Okay, although they have increased it almost for 40 years, okay, and they do have a lot of cash, okay, free cash of $40 billion, that doesn't look basically healthy at all. That does not look healthy to me at all. But they have a profit margin of 8.34%, okay, so some people say they're not profitable anymore. These companies are. They dinosaur, but they've been around for hundreds of years, okay, they do have a lot of cash, but they burn a lot of cash as well, genuinely. Okay, total return is only 4%. 4% over 10 years, just like every single year for 10 years. That's not a lot, but at the same time, with that 3.88 dividend, okay, obviously that's the total returns. It's enticing at times, but you know what? Because of that safety, I will stay away from it. I'll be honest with you. Okay, growth estimate next 5 years, we're expecting about 9%. So again, it's expecting to grow. It's fairly valued at the moment. The price is expected. The price is, I think, 96. Fair value price is about $96. Okay. So again, for me, although I really want to add oil companies, I'm still not. Every time I want to pull the trigger, something stops me. I don't know what's going on. So we'll see. We'll see. I've got no oil companies in my portfolio yet, but we'll see. Home Depot is the next company, 2.66% of dividend yield. 5-year growth rate of 18%. That's absolutely amazing. So if you bought, for example, say £5,000 worth of this company in 5 years, they increase your dividends. Okay, so that in dividends basically 2.66 is actually increasing about that rate every single year. The payout ratio is very low, about 43%. Safety, almost 100%. They have increased this dividend for 34 years, so they are dividend aristocrats. Okay, profit margin is perfect. Okay, 10-year free cash flow of $14 billion, and then 10 years of growth, basically total returns of 21. Remember, by the way, this doesn't guarantee like what's going to happen in the future, but it gives us an idea at least where the company has been and hopefully where they're heading. With this type of free cash flow and that's the expectations, hopefully they can actually basically replicate that sort of returns in the next 10 years. 5-year growth rate is about 14.6%, fairly valued at the moment, 264 pounds, dollars. I have been adding to this company because it's in my portfolio, one of the companies that I own, and really great company. I absolutely love it. Just the business model, their business model is absolutely brilliant. Okay. Now, the next company is another oil company. This is probably my favorite out of all the one of the my favorite oil companies out there. That's Chevron. 3.38% of dividend yield, 5-year growth rate for only 4%, 51% of payout ratio, 65% of safety. So it's above what we're looking for. Okay, 5-year basically in terms of dividends, there are 34 years of paying that dividend or increasing that dividend. Profit margin about 11.6%. Free cash flow of $24.77 billion. Okay, so they've got plenty of cash, these companies. Okay, but 8% in the last 10 years, total returns of 8%. And then next 5 years, they expected almost 18% growth, the analyst. Okay, which is quite high. Really, really good. That's like more what you expect from companies like, for example, the tech companies, if you like. Okay, but they have been down for a very long time, so they have got a little bounce at the moment, so we'll see how long that lasts. Okay, 24% premium at the moment. 142 is about basically where it should be right now in terms of price wise. So that is the 5th company. So we're midway through. Let's check the rest of the companies now. So the next one is Pfizer in the healthcare, 3.17% of dividend yield, 5% 5-year growth rate, 31% of payout ratio. Safety 75%, which is decent. 5-year dividend increases of 11 years. Okay, years in dividend increases about 11 years. Profit margin 27%, which is quite nice. And a lot of that has to do with COVID. Okay, well, a lot of the to do with the COVID vaccine, I think. Okay, free cash flow about almost $32 billion. Total return in the last 10 years about 11%. 5-year growth, basically next to 5 years, the analysts are expecting this company not to grow. And a lot of that has to do with the COVID vaccine. This year, they grow their earnings about 77%. But that's not going to continue because hopefully once COVID is out of the window and we kind of, like everyone has been fully vaccinated, whatever, that growth is going to have to come down at some point. Okay, and that's what the analysts are expecting. Fairly valued at the moment. The price should be about 48. Right now, I think it's a little bit expensive. I'll be honest with you, it's a little bit expensive at the moment. About like 53, I think, or $54 per share. A little bit expensive for me at the moment. Okay, so I definitely have a decision to make when it comes to Pfizer, because with that sort of a growth and what I'm looking for, it's not going to fly with me. So I need to look at it. I think I've got like 25 shares of this company, so we'll see. Next one is Eli Lilly, healthcare. The dividend yields 1.33%. 5-year growth rate is about 11%. Payout ratio 40%. Dividend safety 96%. That's what you want to see. Years of increasing these dividends, 31 years, okay, of increasing that dividend. Profit margin almost 21%. They have $5.8 billion in the bank. Okay, total returns up 23%, which is very, very nice. This is why this company is always like basically trading at premium, because of this type of returns that is actually giving us. And the next 5 years, okay, the analysts are expecting this to grow about 18%. So ideally, I would rather own Eli Lilly than actually own Pfizer because of that growth. Okay, and the dividends is actually way less, but it doesn't matter because you're going to get that growth in the hopefully next couple of years. But right now it's not a buy for me. Is basically hold if you have it already. If you want to add to it, maybe whatever, you can do that. But for me, to initiate a new position, I would have to see this come down at least in 19-20%. Okay, $262 per share. That's what it's trading at the moment. Next company is a company that I own in my portfolio, and that's Merck. Okay, so again, remember what we're doing here is we're picking the top 20 or 15 companies in the VYM, okay, based on their the weightings for that, for example, ETF, and basically pick the halal ones, okay, be the ones that we know that are Sharia compliant. So Merck is definitely Sharia compliant. It's got 3% dividend yield, 7% 5-year growth rate, payout ratio 38%, dividend safety 99. They have increased this dividend for 31 years, and profit margin is about 27, almost 26.27% of profit margin. Free cash flow almost to, $13 billion. Total return is in the last 10 years about 11, almost 12%. Okay, and then next 5 years, the analysts are expecting this to grow about 12%. Fairly valued at the moment. Price should be about 94. I think it's about that right now. I think it's about 91 or something like that at the moment. Okay, so I still have in my portfolio. I think I'm up quite a bit. I think I can't remember, like 400, 500. And it wasn't long ago that I used to talk about this company almost on weekly basis because they were so undervalued. I think it was like $60 per share, $70 per share, and right now we're looking about $90-something per share. So great company. The future looks good as well, and they are actually doing. One of the reasons I might look into this company here is because they also have a vaccine as well. So these 3 companies I own, they're all doing the same, more or less the same things. Okay, so I need to look at Pfizer again, and I will let you know whatever happens. I haven't sold it, I haven't done anything with it yet. Next company is one of my favorite companies out there, is in tech sector, Broadcom. Broadcom is actually now in the process of buying VYM. We talked about it in the last video, but they are actually in the process of buying VYM, which is absolutely amazing. This company actually purchases other company like there's no tomorrow, and I think they're paying about $61 billion. It's going to be one of the biggest transactions for basically, or acquisition for this year. So 2.87% of dividend yield, which is really high for a tech company. 5-year growth rate of 43%. Payout ratio 52, so they have a room to improve. Dividend safety 67%, so above what we're looking for. 11 years of increasing that dividend, which is nice. Profit margin 27.5 almost. Okay, then free cash flow almost to $14 billion. Total return in the last 10 years, you're looking at about 35.6, almost 36%. 5-year growth rate in the next 5 years, growth estimates for the next 5 years is almost 15%. Fairly valued at the moment. Price should be about, according to Morningstar, $545. Okay, really one of my favorite companies. Qualcomm and this company are my favorite tech companies, as well as obviously Microsoft. Okay, these are companies that I own in my portfolio. I love the dividends, I love the story, and hopefully we'll see how it goes. I like the fact that they diversify now from the network side of things and going into more software side of things because of the purchasing, because of the acquisition of what's called VYM or whatever. No, not VYM. VMware. There we go. Cisco is the next company in the last one. 3.14% dividend yield. 5-year growth rate 9%. Payout ratio 44%. Safety 91%. 10 years they have increased that dividend. Profit margin is very healthy of 23%, which is really nice. They've got plenty of cash, so like $14 billion in the bank. Now, the last 5 years, they've been basically total returns of almost 14%, which is very nice. And the expectation is for the next 5 years, this company to grow about 7% every year in the next 5 years. Right now, it's discounted about 19%. Price should be about 54. I think it's in the mid. I can't remember exactly, to be honest with you right now, but 54 is where it should be right now. Right. So the reason like I said at the beginning, I'm sharing this with you is if you are trying to construct your own portfolio, you want to amazing companies that are doing really well, that will pay you dividend. I've focused only dividends here now because that free cash flow, that cash flow that you gain is really important because it helps you compound. Okay, so if J&J pays me £10 and I put it back into J&J or Procter & Gamble, then that £10 will now create more money for me. Does that make sense? So the compounding effect starts. These are companies that are dinosaurs. They've been around for a long time. Yes, the story might change sometimes, okay, but in my like for example, I can leave Pfizer in my portfolio for the next 5 years, okay, and then for the next 10 years, next 5 years, it might actually give me about 2-3% returns, okay, or whatever the dividends are, and then in the next following 10 years or 5 years, it's actually might double that. But the story is these companies are not going, basically, they're not going to be bankrupt tomorrow. And that's what we worry about, because when you put in buying 2% of J&J, you don't want the company to go bankrupt because that you're going to lose all that 2%, right? And that's the whole story. So yeah, if you're constructing your own portfolio, thinking about companies to add to your portfolio, you haven't got any of these companies, do your research, find out if basically if they are a buy for you, and take it from there. I hope you enjoyed the video, and now it's too long, but I wanted to make sure that I'm not doing this just for me. I'm doing it for me, for you, for that kind of the brother that I had the conversation with, because it is quite difficult to find Sharia compliance companies out there that are really like long-term plan, whatever. And in the last few years we got burnt. Okay, we bought companies that are really like high multiples, and we're down. And that's absolutely fine. Like I said, I made a mistake, and I'm going to share that with you guys in maybe next video. But we don't want burnt anymore. We want a stable income by stable companies that are going to be around for a long time, happy and around for a long time, have a good future ahead of them. Okay, hopefully they're undervalued. Buy them at the right price so you don't get burnt. Okay, I hope you enjoyed the video. Assalamu Alaikum. Take care.